All right, well, let's get started. Welcome, everyone, and good afternoon. Thank you for joining us for our webinar today on emergency capital raising for public companies. Now, Gowling WLG has already hosted a number of webinars relating to the impact that COVID has had on M&A transactions. And here's a list of the past seminar webinars, as well as upcoming webinars on both M&A transactions and financing activities. If you've missed any of the past webinars, these are available on demand on the Gowling WLG website. So a couple of housekeeping matters before we get started with today's presentation. First of all, to view the presentation and all of the speakers, please click on the speaker view in the upper right-hand corner of your screen. And for questions throughout the session, please use the Q&A buttons at the bottom of your screen, and we'll try our best to answer your questions towards the end of the session. But if we don't get to any of them, or if we run out of time, please feel free to reach out to any of the team members after the webinar or to your customary legal advisor at Gowling's. The presentation is being recorded, and it will be posted on our website in a few days in the event it's so riveting that you want to watch it again. For those of you who are lawyers, this program counts for 1 hour of continuing professional development credit in applicable jurisdictions, and details of these credits are set out in the invitation for this webinar. Because this presentation is being put on by lawyers, we'd be remiss if we didn't include an appropriate legal disclaimer. Today's session is a high-level overview for general information purposes and does not constitute and should not be considered as legal advice. The information has been summarized and paraphrased for presentation purposes, and any examples are provided only for illustration. If anyone has any questions about specific circumstances or any of the topics covered today, please feel free to reach out to the panelists or to your legal advisor. And please remember that every public company's situation is different, and specific advice should be sought on the topics herein. Information in this presentation reflects securities laws and other relevant standards that are in effect as of the date of the presentation. Now, my name again is Stuart Ollie, and I'll be your moderator today. I am the head of our Natural Resources Group in Canada and based in our Calgary office. Joining me on the panel, Brett Kagetsu, head of our Business Law Group in Vancouver, Peter Simeon, a partner in our Toronto office, Tim Ross, a partner in our Hamilton office, and Gordon Schmiller, who practices with me in our Calgary office. The agenda we'll be covering today will be to look at a number of financing techniques that are suitable or useful in the current environment of COVID-19. As many of you, of course, appreciate, companies currently are, many of them, very cash constrained and have seen falling revenues. So the ability to access markets for capital, either through equity or through debt, is top of the mind for many CEOs. So we thought it was timely to talk about some of the techniques and some of the regulatory relief that's in effect currently that can make accessing equity or debt financing a little bit easier. So first, we thought we'd just give you an overview of some of the financings that are being conducted and some statistics on what's been happening in the last few months during the pandemic. So Gord, over to you.
Great, thanks, Stuart. So as Stu mentioned, we're going to discuss some of the technical and practical issues surrounding different ways to raise capital. But to begin with, some statistics and market information is useful. So I wanted to start with rights offerings. So you go back and look at the rights offerings completed over the last 12 months, you see 17 such offerings raising about $8.2 billion. Now that number is skewed given that Katanga completed a $7.7 billion rights offering during that time period. So if you backed out Katanga, you have $540 million being raised from 16 right offerings in the last 12 months. If we look at what has taken place since the COVID-19 outbreak, say since March 15th this year, then we see there have been 3 rights offerings announced proposing to raise $124 million. The largest is for $100 million and the smallest for $2.4 million. Next, we looked at all equity financings completed year to date to the end of April 2020 and compared that to the same time period in 2019. And here we're talking about all types of equity financings. not just exempt equity financing such as private placements, but including prospectus offerings, etc. What we see is that during this period, there's been no significant reduction in the amount of equity capital raised as compared to 2019, with 9.8 billion being raised in the time period in 2020 and 9.6 billion raised in 2019 during the same time period. And in fact, the average size of such financings on each of the TSX and TSXV remain roughly the same. Next, we looked at specifically at exempt equity financings, so private placements. This first chart shows the total amount being raised by private placements year to date to the end of April by TSX listed companies. The red line is for 2020 and the blue is for 2019. You will note that approximately 475 million in total has been raised in March and April of 2020, but for the total amount year to date to the end of April, we are down about 49% as compared to the same period of time in 2019. The next slide is, this next slide is similar to the one we just discussed, but this is for TSX Venture Exchange listed issuers. Again, the red line is for 2020, the blue is for 2019. What you see is about the same total was raised by TSXV issuers through the end of March as compared to 2019. There was about 285 million raised in total over March and April of this year, but we are down about 16% in total to the end of April as compared to the same period of time in 2019. Next, we have a table that breaks down total private placement financings by TSX and TSXV issuers year to date to the end of April, but we break it down by industry. So you'll note that mining issuers have, by far raised the most amount this year by private placement, with just under 1 billion being raised. There have been a number of notable financings by mining issuers these past few months, especially by gold companies. So then we then looked at convertible debt financings. There have been a number of large such financings announced since the COVID-19 outbreak. For example, 550 million in notes by Air Canada, 500 million in notes by Shaw, and 1.25 billion in notes by Suncor. When we looked at private placement convertible debt financings announced just in May of this year, we know 20 such financings proposing to raise $916 million. This includes the 550 million by Air Canada and 317 million by Collier. So if you back those two out, then we have May announcements for 49.5 million with an average offering size of 2.75 million. The smallest is for 181,000. And we're seeing a variety of issuers issuing exempt convertible debt from mining companies to oil and gas, cannabis, tech, renewables, and goods and services. So finally, we wanted to take a look at who is taking advantage of the recent relief of the minimum pricing rules by the TSX Venture Exchange. On April 8th, the TSXV issued a bulletin granting relief from the 5-cent per share minimum pricing requirement for private placements and shares for debt transactions. The minimum price is now 1 cent per share, but issuers' stock must be trading at less than 5 cents per share to take advantage of this relief. In addition, you cannot issue more than 100% of your outstanding shares, and the proceeds from such financings cannot be used for management fees or investor relations. So we see that 13 TSXV issuers have announced private placement financings that rely on this pricing relief. The average size of those private placements is about $460,000. The largest is 1.8 million, and the smallest is about 57,000. Again, a variety of issuers are taking advantage of this relief, from mining companies to tech, oil and gas, and real estate issuers. So that's our summary of current markets, and I send it back to you, Stuart.
Rick, thank you very much. So now we're going to do a bit of a deeper dive into some of these financing techniques. So the first, as you'll see, is rights offerings, which seem quite popular at the moment. So Brett, let me turn it over to you. I know you've had some experience in doing a few rights offerings recently.
Thank you, Stu. Rights offerings can be one of the fair ways for issuers to raise capital because they provide existing shareholders with an opportunity to protect themselves from dilution. What's involved is the issuer issues rights at no cost to shareholders and entitles the holders to purchase additional shares of the issuer. Essentially, it's like a cash call to existing shareholders and provides them with an opportunity to purchase a pro rata portion of the additional shares at a specified price per share, and typically it's priced below the market price. Rights are typically transferable, so if you don't want to exercise, you can transfer them through the exchange. rights offerings typically cost less than a brokered financing because you're not hiring an agent or underwriter to help you with the financing and paying commissions and cost of other counsel. It relies on the existing shareholder base and allows major shareholders with vested interests to retain their proportionate share of the company. Now, key factors to consider is the pricing. Oftentimes, these rights to purchase shares are priced at a significant discount to market. In fact, you're looking at in excess of the allowable discounts allowed by the TSX Venture Exchange and the TSX to entice shareholders to exercise the rights. As I say, the rights have to be transferable to be listed, and CDS, in my experience, won't accept rights for deposit with them unless they are transferable. Now, some rights offerings will have a standby or a commitment or a backstop, and that ensures that the issuer will raise sort of the money that they require to achieve what they want to acquire that's set out in the rights offering documentation. And so you can then get guarantee that you're going to have a certain amount raised for the purposes that you need the money for. Now, these standby commitments and backstops, there's often a fee that's paid to the person that's taking on the risk of standing behind the offering and filling up any amount that hasn't yet been raised by the rights. Something to consider if you're going to have a person who's not an insider do a standby or a backstop, and if it would cause them to potentially cross the 10% threshold and become an insider, you have to note that the TSX Venture Exchange will likely require the person who's controlling that entity to file a PIF and to have it clear through the exchange before they'll allow the person to take up that backstop. So something to consider on a timing perspective is to make sure you try to find out if that could happen, and if that's the case, maybe have the personal information form submitted in advance and cleared before you launch your rights offering. Now in Canada, you can do a rights offering either by filing a prospectus or relying on a prospectus exemption. Now filing a prospectus is quite costly, it's time consuming. Oftentimes rights offerings are not done by prospectus because of that. And in the past, rights offerings were done and are currently done mostly under a prospectus exemption. Now before 2015, the rights offering prospectus exemption was cumbersome. It wasn't very user-friendly and consequently not often used. So in late 2015, the Canadian Securities Administrators in Canada introduced a change to the rights offering regime and streamlined it to trying to make it easier and more cost-effective and more timely to be able to raise capital using rights offerings. Essentially, here are the key elements of a rights offering through a prospectus exemption. You have to prepare a rights offering notice as well as a rights offering circular. Both documents are filed via CDAR and sent to shareholders and advising them about the details of the rights offering and how to participate. The rights offering circular is in a question and answer format, and it's meant to be easier to prepare and more straightforward for investors to understand. The limits for dilution are now 100%, so basically you can't issue more than 100% of your current issued and outstanding. Prior to this change, as I mentioned in 2015, the dilution limit was only 25%, so they're trying to make it more accessible. You could raise more capital. What it does provide is existing shareholders who participate, exercise their rights, they're given statutory secondary market liability. So if there's a misrepresentation in your publicly disclosed documents, certain of your core documents, it could give people who exercise their rights a right to sue you for the misrepresentation and the losses they sustained. Now, if you have shareholders in Quebec, and many issuers, of course, will have shareholders in Quebec, you have to note that you'll have to translate your rights offering circular and rights offering notice into French. So that's something you got to do before launch as well, because when you file the circular and you have shareholders in Quebec, you have to file in French and in English. And on that note too, the rights offerings can allow for US participation as well. You have to talk to US counsel, but in my experience, my clients have been able to rely on a filing in the US to access some of their shareholders who reside in most of the US states. But again, contact US counsel and they can help you make sure that your rights could be exercised in the US in as many jurisdictions as possible. Okay, now when the CSA introduced the rights offering exemption regime, the new regime in 2015, a couple of years later, they did a research to see how the uptake was on the new regime. And they found that the average number of days from filing the rights offering notice to closing was 41 days. So not too long. On average, issuers sought to raise 51% of the outstanding securities of the applicable class through the rights offering, and they actually issued 40% of the outstanding securities. And insiders typically raised 47% of the funds that were sought to be raised. Of 29 rights offerings with a standby commitment, 24 were provided in whole or in part by an insider or a related party. Now, when you're dealing with the exchange, and I'm just talking about the TSX and the venture exchange here, you have to ensure that all your rights offering materials are vetted and approved before you can launch. That both exchanges recommend a preliminary discussion with them in advance of undertaking a rights offering. Under the policies, you have to file a draft news release regarding the offering, a draft rights offering circular, rights offering notice, and a draft specimen rights certificate with a new ISIN and CUSIP number, which you have to order in advance. And again, as I mentioned, if it's possible for someone, say who's doing the backstop or standby, for them to exceed 10%, then you have to file the PIF for that person as well. So you got to clear all the comments on the documentation at least 5 days in advance of the record date for the rights offering. You need to set a record date which says that as of that date, people who are shareholders, registered shareholders, can participate in the rights offering. So as I say, you got to set a rights offering record date and clear all the comments at least 5 trading days in advance. At that point, you can then launch the rights offering by disseminating the news release announcing the rights offering and filing your rights offering documentation on CDAR. Now, the rights offering must be open for not less than 21 days following the date the rights offering circular is sent or made available to shareholders. And the TSXV has said that if a certain amount of funds is to be raised for specific use, the issuer must determine a minimum subscription which must be guaranteed by a person that has a financial ability to satisfy the standby commitment. So that's what I said earlier about ensuring you have a standby person if you have to raise a minimum amount of money for your specific use. Okay. Rights can be used to, can be issued to purchase units as well. Now, the exercise price of any warrant that's forming part of a unit must not be less than the market price prior to the news release announcing the rights offering and not less than 5 cents. And the total number of shares issued on exercise of warrants must not exceed the total number of listed shares issued on exercise of rights. So like on a 1-for-1 basis, would be the maximum. Stu, back to you.
Perfect, Brett, thank you, very helpful. So is it fair to say that rights offerings with a backstop in this current market sort of give issuers an opportunity to ensure that their shareholders can participate? So if their shares are depressed, shareholders have a chance to buy, while at the same time giving the issuers the guarantee that they'll be able to raise funds through the backstop. However, I mean, some issuers obviously will not want to go through that period of time or don't think there'll be significant uptake by their shareholders. So in those circumstances, exempt equity financing might be a better route to go. So Peter, I think you've had some experience recently doing this during the pandemic.
Thanks, Stu. In Canada, issuers can raise equity through a prospectus offering or prospectus exempt offering. I'll be speaking about prospectus exempt offerings or private placements, as we like to call them. Initially, after the COVID-19 lockdown began, there was a reduction in financings. As we think everyone just wanted to see what the new normal was like, and stock markets generally were trading down. A lot of stocks have since recovered since that initial impact, and we've recently seen both prospectus offerings and private placements getting done. In terms of the process, in order to complete a private placement in Canada, an issuer will need to rely on one of the prospectus exemptions available under securities laws. Private placements can be brokered or non-brokered. In Ontario, we typically rely on the accredited investor exemption. Each investor must satisfy that they are accredited, or in the eyes of securities regulators, they have enough financial resources or be sophisticated enough to qualify. For example, if an individual makes more than $200,000 annually or more than $300,000 annually with their spouse, they'd be deemed to be accredited. There are also a number of other exemptions available in Ontario, such as the Friends and Family exemption, the Close Business Associates exemption, over the Offering Memorandum exemption. Other provinces have other exemptions as well, and I'll just turn it over to Brett to walk through a few of those other provincial exemptions.
Thanks, Peter. Yes, there is the investment dealer exemption, as well as the existing security holder exemption, which were well used, especially at this time. They're available for issuers. They're not available for issuers based in Ontario, but several other provinces have this exemption available. And it's what it does entail is a few things. Your subscription agreement has to have a contractual right of action where the investor was able to basically have a right of action to sue the company if there's a misrepresentation in their continuous disclosure. There's a news release that needs to be issued that announces that you're going to rely on these exemptions and the use of proceeds to which that you're going to be applying the funds. And for the case of the existing security holder exemption, you need to disclose the record date where you have to be a shareholder to be able to participate, as well as the maximum number of shares you're going to issue under that exemption. And if there's excess demand, how you're going to apportion, the excess subscription amongst all the people who want to participate. The existing security holder exemption, all you have to be is an existing security holder as of the record date. You don't need to be an accredited investor or qualify under any other exemption. And an investment dealer exemption, to participate, all you have to do is to actually get some suitability advice from an investment dealer. And once you certify you got that advice, then you can participate. You don't have to be an accredited investor. So these are also very helpful exemptions.
Thanks, Brett. In terms of pricing, there are also specific stock exchange rules around private placements. For example, on the Toronto Venture Exchange, you can only issue shares within a permitted discount to the market price, which ranges from 15 to 25% depending on the current share price of the issuer. If you're doing a unit offering, warrants also have a limit on the exercise price, which must have a premium also ranging from 15 to 50% of the market price of the shares, again, depending on the exact share price where you'll fall within that range. Other exchanges, such as the CSC, also have similar rules. Because of the COVID-19 pandemic, certain stock exchanges have issued revised rules for minimum pricing of private placements. As was noted earlier, the TSXV has provided temporary relief from certain requirements of its corporate finance manual to reduce the minimum price at which listed shares may be issued in private placements, public offerings, shares for debt transactions, and as bonuses for loans or guarantees. Under this temporary relief, where the market price of an issuer's listed shares is not greater than 5 cents, the minimum price at which such issuer's shares may be issued will be the market price, subject to a minimum price of 1 cent. In order to complete a private placement, an issuer will need to either announce the placement in a press release or file a price reservation form. Technically, issuers can wait until closing the press release, but that introduces pricing risks. So most issuers either file the price reservation form initially or announce the placement in order to lock in the pricing. Under TSXV rules, if insiders of the issuer will be subscribing for greater than 25% of the private placement, the proposed offering price must be reserved by the issuance of a press release and can't be done through the filing of a price reservation form. Where the issuers reserve the proposed offering price using a price reservation form, and insider participation in the placement will be greater than 25% of the placement, the price reservation will not apply to that insider participation that is exceeding 25% of the placement. Whether a proposed offering price is reserved by way of a news release or price reservation form, such price reservation will lapse if the issuer does not file or the exchange accepts the proposed terms of the placement within 30 days of the price reservation date. So because of the COVID-19 pandemic, a number of regulators have issued temporary relief from certain securities rules. Some of that relief is particularly important in the private placement context. The first exemption worth noting is the CSA blanket order allowing delays in filing certain continuous disclosure documents. The CSA has published blanket orders that grant temporary relief to market participants in connection with the filing of certain continuous disclosure documents and other documents due before June 1st, 2020. This was recently extended to August 31st, 2020. The temporary relief extends the filing deadline for certain continuous disclosure filings and other exempt market filings by 45 days, subject to meet certain conditions. Of particular note, this relief applies to filing interim annual financial statements. So it's important to distinguish the relationship between the initial March 23rd relief and the recent May 20th relief. It's important to note that these set of orders, the first set dated March 23rd provides a 45-day exemption for documents required to be filed on or before June 1st. And the second set dated May 20th provides an exemption for documents to be filed between June 2nd and August 31st. There are two critical takeaways in relation to these two sets of orders. First, issuers have to comply with the requirements of each set of orders to rely on them. And second, the May 20th orders do not extend the filing deadlines for documents required to be filed on or before June 1st. For example, an issuer relying on the March 23rd orders to extend the filing date for its Q1 financial statements from May 30th to July 14th could not use the May 20th orders to further extend its Q1 filing deadline. However, the issuer might rely on the May 20th orders to extend its Q2 filing deadline from August 29th to October 13th. So in essence, you can't use the additional orders for an additional 45 days for the filings that fell within the first period. It's got to be for new filings that fall within the second period. You get another second 45 days. To the temporary relief, including a prohibition on filing a prospectus until all documents are delayed in reliance on the temporary relief are filed, and a requirement that issuers confirm that management and other insiders are subject to an issuer-imposed insider trading blackout, and they provide updates with respect to other material business developments. Among other things, material change reports, early warning reports, and the extent applicable insider reports are not subject to any relief. In order to rely on the temporary relief in connection with these filings, the issuer must issue a news release both before and after the applicable filing deadlines. So there are two releases. There's a pre-deadline news release. This must be filed prior to the applicable filing date. The press release must disclose the relief being relied upon, the estimated filing date of the relevant disclosure document, and update on any material information that is made, management is subject to, and also that management is subject to an insider trading blackout until the filings have been made. There's also other post-deadline news releases. This must be filed within 30 days of the filing deadline, providing an update to the market, as well as every 30 days thereafter until the filings have actually been made. Importantly, as noted earlier, issuers relying on the temporary relief may not file a prospectus, a preliminary or a final prospectus, for an offering of securities until all the documents for which the temporary relief is relied upon have actually been filed. For this reason, we initially saw a lot more private placements as issuers relied on the first 45-day relief. And now that some of those filings have been made, we're starting to see more prospectus offerings. The temporary relief also extends the deadline for the filing, sending or delivering of certain other exempt market filings by 45 days. Such filings include annual financial statements required to be filed in connection with an offering memorandum exemption, as well as the related notice of use of proceeds on Form 45-106 F16. Also, annual financial statements and annual disclosure of use of proceeds required under the crowdfunding rules and exemptions. In these cases, the temporary relief is also conditioned on the filing of an applicable news release in advance of the filing deadline. Other documents, such as a filing of change of auditors, notice of change of year-end, business acquisition reports, notices of change in corporate structure that fall before August 31st will also get the benefit of the 45-day extension. Again, provided the issuer disseminates the applicable news release. Further, the expiry date for a final base shelf prospectus that is set to lapse before August 31st may also be extended by an additional 45 days, provided that the issuer issues and files on SEDAR a news release in advance of the lapse date, and provided that the issuer is not relying on the temporary relief in connection with its annual financial and interim financial statements. In respect to the capital pool companies, I know we have spoken with the TSXV and asked if they're issuing any specific relief relating to capital pool companies, and specifically the requirement that they complete their qualifying transaction within 24 months of listing. Although we've been told that the exchange will not be issuing formal relief, we do understand that they will be more accommodating with specific relief on a case-by-case basis. If you have a CPC that's getting near to its QT deadline, we suggest you contact the exchange or contact us to help deal with that specific relief. Stu, any thoughts about specific practice points related to this, private placement relief?
One of the areas that I'm getting a lot of questions is the interplay between the blanket orders that provide temporary hardship relief on filing of financial statements and accessing the market. So you noted correctly that those blanket orders provide limitations on the rights of insiders to trade in the stock while there has not been disclosure of financial statements or other material information. And so this is an important point for people to think about if you are accessing the market, because as Brett pointed out in his comment on rights offerings, very often we see that it's insiders who provide backstops or participate in that rights offering. Or if you're doing an exempt financing and you're having insiders participate, you really need to give some thought as to what material information those insiders might be aware of that may not have been disclosed to the marketplace. And in such circumstances, there'll be limitations on the rights of those insiders to participate. So that's an important interplay if people are taking the benefit of the temporary relief on filing financial information, for example, where insiders might have some color on what the financial information is. But I think as you mentioned, people now sort of having 3 months into the pandemic are getting used to practicing remotely or working remotely, and they're getting caught up on filing the financial information. So as the public disclosure record comes current, that will be less of a challenge for issuers, but certainly something to think about if you're relying on the blanket orders.
I had a comment on that as well. If an insider or an officer subscribed for shares under a prospectus exemption and the 4-month hold period expired, they may be prevented from selling their shares as well, because one of the requirements on the resale rule is that the selling security holder, if they're an insider or officer, has no reasonable grounds to believe the issuer is in default of securities legislation. So if they're in default because they're relying on this exemption, then they may not be able to trade their stock, even if the 4-month hold period has expired.
Right.
Those are all great points. Going forward, we expect to see issuers accessing the capital markets, both through prospectus and exempt offerings.
Yeah, and certainly with the statistics that Gord was putting up earlier, Peter, I think, I was a bit surprised, frankly, that the drop-off in offerings is not more significant than the numbers are showing. So I agree. I think that, people are sort of getting on with business as usual and recognizing that, we have to sort of make things work and access capital markets as appropriate. Now, as I mentioned, many issuers, are facing significantly depressed share prices, none perhaps more so than in my home jurisdiction of Calgary, where many of the oil and gas companies are dealing with not only COVID-19, but also the meltdown in commodity prices in the oil and gas sector. So in those circumstances, issuers may decide that neither a rights offering nor an exempt equity financing or prospectus financing is appropriate simply because of the dilution occasioned by their equity prices. So in such circumstances, debt offerings, either convertible or straight debt, might be more appropriate. So Tim, maybe you can take us through some of the rules and what you're seeing in the debt markets right now.
Sure thing, Stu. Thanks very much. And good afternoon, everybody. We're going to talk about straight debt in just a few minutes, and we've come through the rights offerings and equity discussion. And so right now we're going to talk about the hybrid instrument that falls in the middle. That's a convertible debt instrument. They're very flexible instruments. There are a bunch of different features. We'll touch on a couple of those today. That flexibility allows for them to be applied in a bunch of different situations. And one of those situations is times of economic uncertainty, either generally or for one particular company issuer. And of course, that's where we find ourselves today. And as you saw in the data on the slides earlier in this presentation, that uptick in convertible debt issuance is already apparent, and I think we expect that to continue. And as Stuart says, one of the drivers there is dilution risk. If your stock is trading a low price and you're looking at equity, you've got dilution on your mind. Another key constraint is debt capacity. Every company has its own characteristics which imply how much debt it can carry, and that can be driven by its asset base or by its cash flows. But whatever it is, sometimes we bump up against debt capacity constraints and enter the convertible debt instrument. Some of the benefits to an issuer are pretty straightforward. So first and foremost, you can often get a lower coupon, a lower borrowing rate on a convertible instrument than you would get on a straight debt piece. And that's because the conversion option is a sweetener for the holder that will allow the holder to give up a bit of coupon. You can also raise more debt, and again, perhaps at a lower price than you may otherwise be able to. This is, of course, the point on debt capacity. And again, it's the conversion feature that allows for that to happen. And we've touched on how a convertible debt avoids, to an extent, the dilution in the equity, and that's very real. And convertible debt is less dilutive typically than a rights offering, although it depends on where the strike price is set, but it certainly can be less dilutive. And it's also important to remember dilution in voting. In a convertible instrument, there's less dilution in the voting, really in two respects. One of them is in time. The dilution would only happen later and isn't certain to happen. It's only if the instrument gets converted. And again, depending on the strike price, the dilution is lower. The main benefit for an issuer is really the marketability of these instruments. The hybrid debt and equity feature is attractive in the marketplace. And if you think about it from a holder's perspective, it certainly may feel like you're getting the best of both worlds, where you have the certainty of a debt obligation with a fixed amount and a fixed time period, and yet at the same time you retain exposure to the upside and the blue sky if the stock trades up. A couple of risks should be highlighted along the way. The main one, which is true of any debt instrument, not just convertible debt, is a refinancing risk. And so depending on the time period for which this money is going to be borrowed, or up to a conversion date, the issuer has to figure out a way of paying that money back. And a lot of what we're seeing these days has a bit of the air of the temporary, stopgap measures to help companies move forward with their business plans. But it's important to keep an eye on what's going to happen at the end of these timelines and fully assess that refinancing risk. And there's one way to get rid of that refinancing risk completely, which is to use a particular type of convertible debt instrument, which is a mandatorily convertible instrument. And that means the holder has to convert into equity, either absolutely or under defined circumstances. Now, that's an interesting feature. However, it's of course less attractive to the holder, and therefore some of the benefits I've mentioned just a few minutes ago are not a feature in mandatory convertibles. Particularly, the coupon tends to be higher in those instruments. There's another thing to consider for any issuer of a convertible bond, convertible debt instrument of any kind, and that's the possibility of market arbitrage. And so if people are keeping an eye on their stock price, and there may be some downward pressure on that stock price these days, the thought of short selling may not be welcome. There is an arbitrage strategy that's very common. For the holder of a convertible debt instrument, you are long in the equity through the conversion feature, and so oftentimes that is hedged by an individual holder by shorting the underlying stock. It's a common strategy. In terms of the process for issuing one of these instruments, it's not terribly different from issuing either equity or debt. You've heard the prospectus requirements and the prospectus exemptions. It's the same story broadly. the one thing to keep in mind is that it takes a little bit longer to structure and document these things just because of that dual feature, the hybrid nature of them. And as a consequence, the transaction costs go up incrementally. But beyond that, it's not materially different. And to be sure, sometimes we look at convertible instruments that are listed and traded, and sometimes not. Sometimes these are private transactions. The conversion terms are a very important feature of these instruments, and it takes quite a bit of study to get them right. And there are myriad options for how you can set up a convertible instrument. So for instance, you could have a forced conversion if the equity appreciates through a certain threshold. And it's, I guess, important to mention also that market practice varies jurisdiction to jurisdiction. So what's common in Europe, for instance, departs a bit from what's more common in North America. In North American converts, there's two features that are quite common that we would highlight. The first is a protection for the holder. It's called a ratchet provision, and this protects a holder in the event of an intervening transaction at the issuer, such as a change in control. And there are different formulations. The common one is a make whole provision, where essentially the holder is made whole, notwithstanding the change of control. Second common feature that we'll mention is contingent conversion rights, or so-called COCOs. What that means is that the holder will have some limits around when they can convert. So for example, there could be a rule specified in the bond terms that says you can only convert if the stock is trading at, say, 125% of the conversion price, and perhaps for a sustained period of time. Now, very, very interesting instruments. We would encourage issuers to consider them. We would also strongly encourage them to work with their financial and other advisors on them, because it's very important to get these right. They do kick out a number of disputes on the occasions where they're not done right. And Brett, of course, the exchanges have some requirements for issuers of convertible instruments as it comes to the conversion rights. So wondering if I could turn to you to share a few thoughts on that.
Sure, Tim. Yes, the convertible debentures, convertible instruments are be a private placement under both TSX Venture and TSX rules. You'd also make a filing, of course, for the CSE too, because it's potentially issuance of shares when they convert. Now, the pricing rules for the TSX Venture exchange are that the conversion price cannot be less than the market price. And the market price is the closing price on the day before you announce the financing. There's no discount applied to that. Be aware of that. That's for the first year. Now, if your convertible debenture is for a term of more than 1 year, then your second year has to be at a minimum conversion price of 10 cents. So that's TSX Venture Exchange. On the TSX itself, there are some limits. You could either price the conversion at either the discount to the market price, which is the 5-day VWAP at the time of issuance, or a discount to the 5-day VWAP at the time of conversion, but it's not the lower of, it's either. Or you could do the lower of the market price, which is the 5-day VWAP at the time you price the convertible debenture conversion price, or the market price at the time of conversion. As I mentioned earlier, if you have a convertible security that could result in a new insider, then you have to have a PIF filed with the TSX Venture Exchange and cleared to ensure that the new insider will be acceptable to the exchange. So that could provide a bit of a delay. Where I've seen that you could kind of maybe not have that requirement if you put a limitation in your convertible debenture that the person cannot convert the debt into shares to cause that person to be a 10% or excess, 10% or more holder of the shares. So then the PIF won't be required in that case, because they'll never be able to go above 10%. Now the TSX has the 25% limitation on dilution as well. And so you got to be aware of if the convertible security could convert into more than 25% of the issued outstanding, in which case that could trigger shareholder approval. So you got to be aware of that requirement. Now, on this topic, if you issue a convertible security that you're a TSX issuer and it could be more than 25% dilution, then you can rely on the financial hardship exemption from shareholder approval requirements. But note that if you do rely on the financial hardship exemption from getting shareholder approval under TSX policies, that will trigger a delisting review. So be aware of that, it's available. And also if you're dealing with a related party, you got to consider the related party rule, which is Multilateral Instrument 61-101, which deals with special transactions involving related parties. And where this bumps up into sometimes is the requirement to get majority of minority shareholder approval. So got to be careful if you're dealing with a related party or an insider and you're issuing them convertible security to make sure you address those requirements and find out if you need to get majority of the minority shareholder approval.
Thanks, Brett. So Tim, one of the questions I get from time to time is whether people who are issuing convertible debentures need to be mindful of their existing debt obligations. In other words, whether if they have a bank line that requires consent for further indebtedness or if they have financial covenant ratios, do we consider convertible debentures the same way when we think about those, even though they could ultimately be converted to equity?
Yes, in a nutshell, and in fact, you have to consider both the debt characteristics and the equity characteristics, and the number of different circumstances that Brett has just described for us. These are very real. There's a lot of things to work through. But Stu, on introducing a new layer of debt into a capital structure, absolutely, you need to review your existing loan terms. And you've got to watch out not just for express covenants, limits on debt, limits on granting security, but you also have to work your way through the financial covenants to make sure that the incurrence of a convertible debt obligation wouldn't put you offside one of those covenants.
Great. Maybe now, Tim, you can turn and just talk about, if convertible debt is not an option, what are you seeing in the market for conventional or straight debt financings?
I'm not sure that there's a huge amount of credit being extended by banks these days, and I think that when people go out to try to place debt in the market, they are looking to enhance it in one way or another. So that could be either a credit enhancement by providing more security than they may typically have done in the past. It could be a pricing enhancement where they would pay more for the debt. There's one particular feature that we've seen a little bit of, which is on the topic of prepayment. And again, some stuff that we're seeing these days has the air of the temporary about it. So that could this please be a temporary solution that gets us through our current challenges? And that's a very normal and practical thing to try to do. But people also want to give themselves a backdoor to get out of it as circumstances may change. And so if you're borrowing debt, you may want to have the ability to pay it back early if you're able to refinance it one way or the other. And so, now that's typically not a huge problem, but oftentimes, the market will demand a prepayment fee. And so we get into the prepayment premiums and non-call features. A non-call feature is one that says you simply are not allowed to pay back the debt for a certain period of time unless you compensate the holders of that debt for their losses. The theory behind this is really straightforward. If you have a 10-year term in an instrument, it's riskier at the beginning and it's less risky at the end because time is risk. And so if you have a fixed coupon instrument like a mezz note, say it's at 10%, it's seen as unfair to ask the holder to weather those riskier years and then pay them out before they get to enjoy the less risky years when it's a fixed coupon throughout. So that's why a non-call feature makes sense. That's why make-whole provisions and prepayment premium make good sense. Premia make good sense. The anecdotal observation is that those seem to be really high these days. People want very high prepayment premiums, including for debts that are not long dated. So that's just one thing that we've noticed that we'd encourage people to keep an eye on.
Interesting. So those are sort of the 3 or 4 clearest ways that we're seeing people accessing emergency cash at the moment. But there are a couple of other novel ways that we just thought we might touch on briefly. And as I mentioned, I'm based in Calgary. So with oil and gas, we see quite a lot of royalties as a way of financing oil and gas development. It's also common in the mining sector to see offtakes or stream financing transactions. So Brett, maybe I know you do a lot of mining work out there in Vancouver. You could comment briefly on what you're seeing in offtakes and streams or royalty transactions as a way of accessing financing for resource issuers.
Thanks, Stu. Yeah, I've had several clients access sale of royalties like as a way of raising capital, because it obviously is good because you don't have to dilute your shareholders. You do sell a percentage of the value of the production when the property goes into commercial production. You have to be very careful because, you know, if you saddle the property with too much in royalties, that could make it uneconomic. So you got to be very careful if you're going to sell a royalty. And you see all types of different royalty documents, and you know, sometimes it's tacked on an option agreement where there's a royalty granted to the holder of the property as part of the consideration for optioning the property to the mining company. And sometimes these royalties aren't very well described. So I would encourage people to make sure that these royalty provisions are well described, because it just makes it more clear and makes it for you know, whenever you get into the situation where you have to pay the royalty, that you have clarity on the terms. As for streams, I think streams are used generally by issuers that further along in their life cycle in the mining stage. So they're looking to raise a big amount of money for, say, mine construction, further development, and that's when streams are often used. And these things take a lot of time and they're often very complicated. So, you know, it's not something you can put together in a quick way. But royalties, you know, I'm entered one today, or one of my clients, to sell a royalty on their property. So it is something that's more commonplace.
Great, thank you. Then the other sort of novel thing that we sometimes see in ways to find emergency financing is factoring of receivables. So this is more typically seen in manufacturing companies or sales organizations where they might accrue a significant receivable portfolio and then find a way to access that as security. So Tim, I'm sure you see a lot of that in your practice.
Absolutely, Stu. It's a very important aspect of financing for these companies, and particularly the working capital that's necessary for them to deliver the industrial goods that they produce. A receivable is a receivable. That's when the customer of an industrial company, for instance, it owes that industrial company some money, but maybe it won't pay it just yet. That's an asset, and that asset can be financed. The big banks provide financing for lots of Canadian industrial companies. They use a borrowing base approach to this. Typically, the receivables are a big part of the borrowing base. Sometimes inventory is also included in there. And that's great, but oftentimes it's not every receivable that counts for that type of a facility. And they put a haircut on it. Maybe only 75% of your eligible receivables, for instance, would provide a borrowing base against which you could borrow. In addition to the bank providers, I'll just quickly, Stu, mention that, you know, there are a bunch of specialty providers out there who really focus on this stuff, get much closer to the story. And so that 75% number I mentioned a moment ago can go up higher to 90%. The round trip might be a little more costly with the specialty providers, but at least you get more financing. And indeed, there's some hyper specific examples of this. So really big customers out there, such as an Amazon, you know, the various suppliers to Amazon can take an Amazon receivable to a dedicated finance shop that all they do is factor Amazon receivables. So it's a very useful space, and again, it's especially these days when liquidity is everything, and trying to keep your business running and keep product running through your shop floor. That working capital financing through factoring receivables can be really important.
Perfect. Thank you. We have a few minutes left, so I'm just going to turn to some of the questions that we've received from our attendees today. And the first one is a question relating to the comment we made on reliance on the blanket order for delaying filing of financial or other corporate information. And I think the comment we made that you have to be cautious because insiders in that circumstance may be subject to insider trading restrictions. So the question is, what if an insider is not a board member or staff or an agent, but holds more than 10%? What are their limitations for purchasing in the open market? So the answer to that is that the blanket order relief indicates that you need to have a insider trading policy that is enumerated in one of the national instruments. And typically what that will provide is a policy that insiders not trade when they're in possession of material undisclosed information. Under Canadian securities law, people who hold more than 10% of an issuer are considered to be insiders, but they are in a somewhat different class than officers or directors in that their informational situation may be different. On occasion, insider shareholders, 10% shareholders, may have representation on the board of directors, in which case they'll typically have the same information as officers or directors. But where they don't have that access to information, then under the blanket order, they would not appear to be subject to the same trading restrictions that officers and directors would be subject to. So again, I think this comes back to the comment that really needs to be analyzed on a case-by-case basis. But obviously, where an insider has accumulated shares in the marketplace and doesn't have a seat on the board of the issuer or other access to information, there's very little an issuer can do to prevent them acquiring more shares. It should be pointed out, however, that the blanket relief on filing of information does not provide extensions for filing insider trading reports or early warning reports. So to the extent people are active in the market and they're insiders, they still must file those reports on time. And if they're 10%ers and go over the additional 2% thresholds, they need to file their early warning reports on time. We did have another question, Tim, on whether or not we have any information on withholding tax obligations for cross-border interest payments, assuming no treaty benefit. I think that's a fairly specific question that's going to depend on the jurisdictions and
That's right.
the relevant tax codes. So I'm not sure there's a general answer for that.
Quite, and Stu, as we made clear off the top, we can't advise on any particular situation, obviously, but Canada does have a withholding tax regime, which means that if you're paying interest over the border outside of the country, you need to deduct and remit to Revenue Canada or the CRA a portion of that. The headline rate is 25%, and that rate can come down under treaties, typically double tax treaties. There are many different approaches in the I'm not an expert in double tax treaties, but I have worked with people who are, and I've seen a bunch of them. It tends to come down to 15%, 10%, 5%, and sometimes can be eliminated completely. However, as soon as you get into looking at these things, you have to really watch out for related party transactions. If there's anything involving related parties, then you get into transfer pricing analysis pretty quickly, and there's a lot of focus on back-to-back loans. So it's a important topic area, but it's not one that can be easily summarized.
Probably not something we can deal with in a 1-hour webinar. There was one supplemental question on the insider filing obligations, querying whether early warning reports must be filed on CEDAR or whether insider reports on SETI are sufficient. You, in fact, have an obligation to file both. Early warning reports are filed via CEDAR, and insider reports are filed via SETI. If you blow through the early warning obligation as an insider by acquiring additional securities, you have to file in both places. You have to file both reports. One is not sufficient. So I think that runs through the questions we've been asked, and it also runs through our allotted time. So I would like to thank all of the attendees for joining us today for this webinar. I hope it was helpful. And if you have any further questions, please feel free to reach out to any of the panelists or myself or your legal advisor at Gowling's. And thank you to all my panelists for what was a very helpful and informative webinar. So I wish everyone a very happy afternoon, and thank you very much for joining us.